You're now listening to Alpha Leak, a podcast mini-series highlighting the most under-the-radar projects and developments in crypto. And this series is brought to you by the Blockcrunch podcast. I'm your host, Jason Choi. I'm a general partner at Spartan Capital and an active DeFi angel investor. Nothing on this show should be construed as financial advice, and my guests, myself, and my employer may hold positions in assets discussed on the show. And if you'd like for your project to be featured on this series, reach out to me on Twitter at Mr. Jason Choi. This episode is also brought to you by Paraswap. Stick around to learn more. Hey everybody, welcome back to another episode of the Blockcrunch podcast. Now, by now we've had a few fixed income protocols on the show before, and if you've been following the show, you know we've talked to the folks at Barnbridge, Saffron, Pendle, soon Tranches, and they all have the unique designs in this growing space. Now, the latest one I'm particularly excited to discuss today, and it's called Notional, and I'm really stoked to have their founder, Teddy, on the show with us. So welcome to the show, Teddy.
Thanks for having me, Jason. Happy to be here.
Absolutely. Now, well, Teddy, you have a very interesting background. I know you studied mathematics, right, at Madison.
That's right.
And then you were a trader for a while before jumping into crypto full-time. But before even starting Notional, you traded crypto full-time for a while, right?
Yeah, that's right. So just to give you a kind of a quick overview of my background, kind of as you said, I was a trader for 5 or 6 years prior to starting Notional, mainly at Barclays Investment Bank, where I traded interest rate swaps. But then, I traded crypto after that for about a year and a half at a family office in London called Ianda Capital prior to starting Notional. And basically, I was really when I was working at the bank, I always enjoyed trading, but I sort of felt that I was in the industry of the past, I felt that the thing I was doing, it didn't make sense. It wasn't going to be how finance worked in 20 years. So as a really young guy, just starting out, I was sort of asking myself, why am I here? What I should be instead, in something that's growing, something that's going to be the future. And so I was sort of looking around for that. And, naturally that led me to crypto. And so I was super happy and excited to sort of get out of traditional banking, get into crypto. And it's been great ever since.
Yeah. And was there a specific project that kind of gave you the conviction to pivot into this industry? Or was it more just general awareness of, wow, this seems like it's going to be the future of finance. I have to do this.
Yeah, I guess so. I got into crypto. So I started trading crypto when I was in, I would say 2018. Mm-hmm. And that kind of, I'd seen the whole massive run up in 2017. That obviously caught my attention. I think it caught everyone in the world's attention. Yeah. And so, that came at a good time for me because I was, kind of as I was saying, had these questions about where my industry was going. And I was looking around for what to do instead. And so it seemed like crypto presented just this amazingly exciting opportunity. And it was something where, it was financial. So I felt that I could apply the expertise that I learned in my job as a trader professionally in crypto. And, so that's what I did. So I got in as a trader in crypto. And, over the next 18 months or so, I sort of learned a lot about crypto. I learned a lot about the technology just because I was very interested. And sort of I got to know the lay of the land as a trader. But then sort of towards the end of 2019, so maybe towards, summer 2019, I started to really take notice of DeFi. And I always thought it was cool, but it was so small that I could never participate in a professional capacity. Just because there just wasn't, enough opportunity. But I thought it was super interesting. And, I think somewhere in the summer of 2019, Compound was just starting to sort of come to, prominence. And that to me felt like that to me was like the first step in a real interest rate market on chain that was completely decentralized and just, no humans involved, right? And that I found just really cool. And, kind of my thought there was that the natural next step would be the ability to lend and borrow at fixed rates of interest instead of just variable rates of interest. And, that seemed to me just be an enormous opportunity because, where I come from, or where I came from, the vast majority of borrowing and lending happened at fixed rates of interest. And, I think about things in terms of sort of a yield curve, right? And so you have the day zero rate, which is compound, but then the entire rest of the yield curve out to 50 years, and that was something which was like a totally blank space in DeFi. So like, it seems to me, it was like, okay, now we have this money market, this day zero rates, but the entire rest of the curve is still waiting to be built. And so I thought that would be like, well, anyway, I wanted to do that. So I moved to San Francisco and met my partner, Jeff, who's the tech guy, he's the CTO. And, he actually had the same idea. And together, we started Notional.
That's really awesome. I love hearing organic stories like that where people just see these gaps and they have a vision of the world and they think, hey, I'm going to build this part out because no one else is. And this is a great segue to talk about Notional. And I think your expertise in finance really shows. And when I studied the design of Notional, but before we even dive into, fCash and N tokens and all those specific parts, I just kind of love to understand high level how Notional works, right? So the basic understanding for listeners here is that users can deposit their USDC into the protocol. They lock in a rate, say 6% for a defined maturity, say for September. Well, now it's August. So just to start us off, where is this yield coming from? Who is paying this yield to users?
Yeah. So okay. So I think that the best way to describe how Notional works is to start with fCash. But I guess actually what I'll say is it's fixed rate lending and borrowing, as you said. And yeah, the place to start is fCash. So fCash is a token that is kind of like a zero coupon bond in that it is defined by a maturity date and a currency type. So, for example, December 2021 USDC is an fCash token. Now, this token is transferable, it's tradable, you can do whatever you want with it. And on its maturity date, so on December 1st, 2021, for example, it can be redeemed on Notional for 1 USDC. So effectively, it represents USDC at a specific date in the future, its maturity date. Right? And the way we enable fixed rate borrowing and lending is by allowing users to trade USDC today for USDC in the future at a specific date. And the exchange rate at which they make that trade implies a fixed interest rate over that period of time. So, for example, if you want to buy some USDC on December 1st, 2021, and you pay 99 cents today, and you're getting $1 on December 1st, you know exactly what your interest rate is over, between now and December 1st. So that's like the basic functioning of the protocol. We allow people to trade cash today for cash in the future and vice versa.
That's a phenomenal explanation. And I'm really curious. So in terms of, who is setting this rate, right? When you mentioned this this hypothetical 10% rate, is there a governance aspect to it or is it based on some other rate?
So it's a market-driven rate. Now, there is some governance in the sense of like we kind of set we set some parameters that affect the sort of trading dynamic, but it is a purely market-driven rate. So the way it works is we have these liquidity pools on chain, which are kind of like Uniswap pools. You can think about them like Uniswap pools, although the liquidity curve is a little different. But so they're liquidity pools, and they have USDC on one side and December 1st, 2021 USDC on the other side, right? So cash on one side, fCash on the other side. And as people trade, so as people borrow or lend, the amount of USDC in the pool and FUSDC in the pool changes, right? And as the amount changes, the interest rate changes. So basically, every time someone lends, they move the interest rate down. And every time someone borrows, they move the interest rate up. So it's purely market driven in a similar way as a Uniswap pool.
And from the user's perspective, if I say if I say lend my capital out in the protocol, can I claim my kind of interest payments anytime I want, or must I wait until expiry?
So if you're a lender, what you're doing is you're selling your USDC today and you're buying USDC in the future. Now you have this FUSDC, like you own this, and so you can do what you want with it. And one of the things you might want to do is convert it back to USDC. So you are free to do that at the prevailing market interest rate. So you can hold it to maturity if you want, or at any time you can convert it back to USDC on Notional's on-chain liquidity pools.
And speaking of liquidity pools, this is one part of the Notional design that I think is really interesting. And you hinted at this earlier, where these pools are kind of similar to Uniswap pools, but you're not using the popular XYK formula that Uniswap is known for. And for listeners not familiar with this is basically how Uniswap, at least before version 3, priced their tokens and guarantee liquidity. I think one of the trade-offs is, if you trade a huge amount of token, there could be a lot of slippage. But I'm curious, so why not use this formula? Is it because of the slippage point, or are there other considerations?
Yeah, so it's basically there's two. Okay, so we needed to use a formula. So we needed to use a liquidity curve that was specially designed for fCash assets, because fCash assets are sort of different from other tokens that you might trade. So basically, we needed two things to happen. So for one, we needed really low slippage. And the reason why is that a very small change in the exchange rate between USDC today and USDC in 3 months, for example, a very small move in that exchange rate moves the interest rates a lot. So let's take, for example, a 1 penny move in the exchange rate between USDC today and USDC in 3 months. A 1 penny move in the exchange rate moves the interest rate 4%. Okay, 4%, right? And so basically, we need the exchange rate to move very, very little, because what people care about is the interest rate. So we don't want when somebody tries to borrow, they move the interest rate from 5% to 500%, right? Like that makes zero sense. So we needed a curve that would result in very, very low slippage for end users, in slippage that makes sense in the context of what we're trading here. So that's number one. Now, number two, and this is kind of the maybe sort of is more of the specialness of fCash. So fCash is different from other tokens in DeFi because it matures. Okay, so on some date, it will expire. Right now, so here's the thing. In the example we just went over, a 1 penny move in the exchange rate between cash today and cash in 3 months moved the interest rate 4%. But let's imagine that we're some time has passed and that 3-month fCash token is now expiring in 1 week. Okay, 1 week. So that same 1 penny move in the exchange rate, when the fCash token is 1 week from maturity, moves the interest rate 52%. Okay, not 4% anymore, 52%. And so what you need is the liquidity curve effectively to change its sensitivity as a function of time to maturity, right? So you need the liquidity curve to change shape as the fCash token approaches maturity, because you need there to be less and less slippage as the fCash token approaches maturity, because what you care about is the interest rate not moving too much, right? And it's something that you really need to get right, because as the fCash approaches maturity, that effect is exponential, right? So the closer it gets, the more the exchange rate movement moves the interest rate. And so you need to have the liquidity curve essentially take that into account, right? So that's kind of more of the special part, I would say. And so that's why we needed to, we needed our own liquidity curve that did all these things and had all the properties you needed so that people could effectively trade fCash.
That's really interesting, and I think that echoes some of the conversations we had on the show before, where we were discussing options protocols, where these developers were creating pools where the curve have to adjust because of the time decay aspect of these options, where the value changes, and that always to me is really interesting. And speaking of these different pools, I'm assuming different fCash has different expiries and hence are not fungible. So do you have kind of separate liquidity pools for each of them? And how do you balance between having the flexibility of having a lot of different expiries versus having enough liquidity for each of these pools?
Right, right. So first of all, that's absolutely right. We do have a separate liquidity pool for each fCash maturity. And Yeah, so there's a balancing act to be had here, right? So you want to give users flexibility, you want to give users optionality and choice, but at the same time, you want to be sure that you don't fracture liquidity. And so, we've landed on what we think is a good balance there. So with and we haven't really talked about Notional V2 here, but I will say that Notional V2 is launching in about 1.5 months or 2 months, and upon launch we're going to have 3 month, 6 month, and 1 year maturities. So we feel that is a good a good balance between sort of offering users choice and but at the same time not fracturing liquidity.
Absolutely. And speaking of V2, one of the innovations that will be coming out from that is also this idea called an N token. I know I'm going to butcher the explanation. So can you help explain to listeners, what this idea is and, how it helps with the user experience of interacting with Notional?
So I think N tokens are one of the major sort of upgrades that's coming in Notional V2, and I think they're really cool. So I think that the best way to explain this is to sort of explain why we developed N tokens in the first place. So if you look at Notional V1, the way this works is a liquidity provider. So remember, we have these different liquidity pools, so we need people to put capital in them. We need liquidity providers. And the way this works on Notional V1 is you provide liquidity directly to a particular maturity, right? So maybe you want to provide liquidity to the December 1st maturity, okay? So as a liquidity provider, you have to choose which pool you want to provide liquidity to. And then when it expires, you have to come back and roll your liquidity forward. Because once we reach December 1st, your liquidity tokens have matured and your capital is just sitting in Notional and it's not doing anything anymore. So you have to come back and you have to roll it and put it into a future maturity. Now, basically, this is pretty tough for liquidity providers because number one, they don't know which maturity they should provide liquidity to. It's not clear, right? They have to make that choice. And if they're not, a Notional pro and, super focused on our protocol, maybe they're not sure which maturity they should provide to. And then the other thing is that, it does require this sort of active and ongoing engagement. And so we felt that some of the feedback that we got from liquidity providers on Notional V1 was just that, this was sort of it was harder than providing liquidity on other sort of DeFi protocols, and it was a real hindrance to people using the protocol and providing liquidity. And so what we did with N tokens is essentially we've made this experience completely passive. So being a liquidity provider is way better on Notional V2, and for two reasons. So the first reason is that we have integrated with Compound. Okay, so whereas on Notional V1 you are providing DAI liquidity, on Notional V2 you'll be providing CDAI, right? And that means that on Notional V2 you're going to be earning the same returns as you would on Notional V1 plus the C token lending rate. So you're getting Compound returns and Notional returns at the same time, right? Which is really cool. So that's number one. Now, number two, we have these N tokens. And what N tokens do is essentially they automate all the sort of interaction with the individual liquidity pools that I was just talking about in the context of Notional V1. So basically, the way it works is we have this N token account. And when you provide liquidity, what you're doing is you're putting your C tokens into the N token account. And the N token account is distributing your liquidity into Notional's underlying liquidity pools. And then it is automatically rolling it forward upon expiration. So what you get as a liquidity provider is you get N tokens, which just represent a share, a proportional share of the assets in the N token account. And the N token account takes care of all the sort of interaction with the individual liquidity pools. So you as the liquidity provider have this N token that never expires. It's ERC20. You never have to do anything. You don't have to choose which pool to provide to. You essentially have been providing to all of the active pools. You're getting a share of the trading fees across all active pools at the same time. You never have to roll anything forward. And you can also borrow against it on Notional, which is really cool because if you imagine, let's say you're a borrower and you want to borrow against your Ether, what you can do is mint an Ether. So deposit your Ether as liquidity on Notional, earn returns, earn note incentives, and then borrow against your N Ether. So it's like you're earning a great yield on your collateral that you're posting against your debt. And so that's another thing that we think is really cool. And ultimately, these N tokens, I think, they're already collateral on Notional, but we think that they make excellent collateral, and we anticipate them being accepted as collateral in other venues in DeFi.
Now, before I continue, I'd love to share one of my favorite products in crypto with you. Now, whenever I want to trade a token, instead of going to Uniswap, SushiSwap, Bancor one by one to see where I can find the best quote, I just go to Paraswap to scan for the best price anywhere. Because Paraswap aggregates all the popular Ethereum dexes and saves me a ton of time and headache in finding where I can trade something for the best price, and lets me trade in one place. Now, the cool thing is they've also integrated with Ledger Live as well, meaning I can now swap at the best prices directly from my Ledger wallet. So seriously, if you're a DeFi trader and you're worried about the security risks of centralized exchanges, but you also don't want to scour dozens of dexes just to find the best price, you have to check out Paraswap. So head on over to paraswap.io/blockcrunch. That's really interesting. So it's almost like a perpetual swap, kind of eternally rolling itself forward without you needing to do anything. Would an auxiliary benefit be the fact that I don't actually even have to pay gas to roll my contracts forward because the gas is socialized in this case?
That's true. Yes.
That's super cool. And I'd love to kind of spend more time digging into this, but I think our listeners would also really love to learn more about the high levels, just because this whole vertical is taking off with a lot of the projects that we've brought on the show recently. So I'd like to kind of zoom out a bit and make sure our listeners are following along from a high level as well. Because in a recent interview with a project called Pendle, we learned that there's three main types of these fixed income protocols. And I would be really curious to see if you have the same way of kind of mental mapping out the space as well. But how we kind of talked about it in that episode was there's the tranching protocols. There's the Saffron and Barnbridge that creates the senior and junior tranches. There's the fixed rate lending borrowing protocols like Yield and Notional. And then there's the interest rate swaps like Pendle and Element. Do you agree with how this is categorized, or is there any other kind of mental map that helps you understand the space?
Yeah, that's I would say that's broadly how I think of it. I guess I might sort of like lump the interest rate swap and tranching protocols together to some extent. I mean, I know that they're different, but I like the way that I think about it is that you have protocols like Element and Pendle and the Barn Bridge as well, and like the way these things work is they take yield bearing assets like C tokens or A tokens and they stick them in a vault, right? And then the way they provide fixed rates of return is essentially by like giving some of the people that put the capital into the vault, they give them a guaranteed fixed rate, and then the rest of the people get some sort of floating rate. And the way I think about it, like as to how we are different, so how the other construction, so like us and Yield, the way we're different is that we work for both lenders and borrowers. And so that's the thing about these other protocols, whether it's a Barn Bridge or whether it's a Pendle or Element, they only work for lenders. So you cannot borrow fixed in their construction. And that's because they don't have collateralization frameworks, and whatever. But like the end result is that you can only lend fixed in those constructions. Now that's a really important difference, and it's in my opinion, it is a key advantage of the construction like Notional, and that's because for one, we get to cater to an entirely new set of users that they do not cater to, but it also has really positive effects for people that want to lend at a fixed rate. And here's why. So basically in traditional finance, and I expect this to be true in DeFi as well, you generally have what's called a upward sloping yield curve, which is to say that as you go further out in maturity, the interest rate goes higher, right? And the reason for that is that in general, borrowers are willing to pay higher interest rates to lock their costs, to lock their interest rate for a longer period of time and avoid interest rate volatility, right? So and that's really valuable to borrowers, right? And so the fact that Notional caters to borrowers and enables borrowers to borrow fixed means that lenders on our platform have access to higher rates of interest than they will get on like a platform like Element that does not allow borrowers to borrow fixed, right? And that's just because borrowers are willing to pay higher rates, and so I anticipate that they will push up interest rates on our platform relative to something like those other platforms that we've been speaking of. Does that make sense?
That makes total sense. And I think a corollary of that is with something like Notional, you create almost like a DeFi yield curve. So this is a very kind of broad question, but what do you think are the implications of the creation of a yield curve for DeFi? Like what are the things that you enable by creating this yield curve in DeFi?
So, I mean, I think that I think that there's kind of two things. So, for one, it gives everyone. So, like, something that's really cool about a yield curve is it gives everyone in the market like a common set of information, right? Mm-hmm. It shows you what people expect interest rates to be in the future, which is very informative, right? Because it tells you kind of like prediction markets, right? Where you can see what the crowd thinks is going to happen in the future. And that's sort of like what a yield curve does. If the yield curve is upward sloping, then maybe that means that people expect interest rates to increase over time, right? And so that's one thing. But I think that, kind of, I don't know if this is more important, but it's different. It enables different kinds of users to participate in DeFi lending markets. So, what you'll commonly see in traditional finance, and again, I expect this to be the same in DeFi, is that different kinds of users are focused on different parts of the yield curve, right? So that there'll be like, maybe like you'll have hedge funds that are really focused on the short end, and maybe like 1 to 2 years and in, because they just aren't working on a longer time frame, right? They aren't borrowing for 30 years because they're just not thinking that far ahead, right? And then on the other hand, you'll have like a company like Ford or GM, right, issuing debt, and they are borrowing for like 30 years because they are thinking on a longer time frame. And so the addition of like maturities that go out to 1 year or 2 year, 5 year, 10 year, it allows people that are thinking on different timeframes than the current sort of DeFi users to participate in DeFi lending markets. And so I guess like I think that's what's really interesting is it's going to enable new kinds of users to use DeFi, right? And I think that that's really cool.
Yeah, and anything that's market expansionary and DeFi, I think, should be supported. And this is obviously something that's hugely market expansionary. And this is actually a question that comes from one of our listeners, and they're interested in what do you see are the main users or main sources of demand for Notional in the coming years? Is it like institutions? Is it more DeFi native users? Or is it like companies like GM, like you mentioned?
Right. So I think that like I'll start with talking about the users that have been using Notional V1. So basically, we've seen two kinds of borrowers, broadly speaking. So we've seen borrowers who are active DeFi users, so people who are uh, borrowing stable coins against their Ether or Bitcoin and using that to yield farm and trade with. Now, this is kind of the common DeFi use case, right? And the people who have used Notional for this have generally been, maybe slightly on the more professional side. And they're people that want to, they just want to fix their interest rate risk, right? Because they want to, they want to yield farm, but they just want to minimize the amount of risk that they're taking. So that's one kind of user. Now, the other kind of user is people who are long crypto. And they're borrowing for real world purchases. So they are not borrowing to speculate on Ether prices. They're not borrowing to yield farm. They're borrowing to purchase assets in the real world. Like, for example, we had a user who borrowed $500,000 to pay off his mortgage that he held with Commonwealth Bank of Australia, which is pretty cool. So that was obviously really cool. But the idea here is that, this borrower, because he was not borrowing to speculate or trade, he was unwilling to use a variable rate solution like Compound or Aave, right? So he was waiting for a fixed rate protocol like Notional so that he could do this, right? And I think that, and I talk about this to sort of talk about where I think sort of the future is going, right?
Hmm.
So, I think that we will continue to see interest from sort of more professional trading firms and DeFi funds who want to, minimize the risk that they're taking. And I think that, frankly, I think that is more true now than ever because DeFi interest like returns have come down so far, right? This is no longer DeFi summer. Returns are no longer sort of astronomical without taking huge amounts of risk. There's more capital in the space. Returns have come down, and I think that fixing your interest rate is kind of fixing the rate that you're borrowing at is more important than ever now because sort of profit margins are getting compressed. So I think we will continue to see interest from sort of funds and people that are sort of a little bit more conservative in the way that they approach their yield farming. But I think that we will also see interest from this kind of new kind of user, right? So someone who is wants to buy real world assets, someone who wants to borrow against their crypto to invest in a business, right? So somebody like a miner, for example, right, that has obviously that earns Ether or earns Bitcoin via their mining activities and wants to borrow dollars to invest in more mining equipment, right? I think that we will sort of see more use cases of that nature, and it's because it's use cases that aren't necessarily based on speculation and based on trading, right? And like for those use cases, you really need a fixed rate in order to minimize your risk and make sure that your costs don't increase tenfold over the course of a month, right? So I think that as DeFi matures, we will get sort of more activity like that. Yeah.
That makes sense. And harkening back to maybe your days as a trader in the traditional financial realm, what were the biggest types of users for zero coupon bonds or similar financial instruments? And do you foresee those same players eventually using Notional as well? Or what is it going to take for those same people to start using Notional?
I mean, I absolutely do see that. And there's just I think you can sort of throw around statistics like the global fixed income markets are greater than $100 trillion, right? I mean, it's just like massive amounts of money. There's just a ton of money that's investing in uh, very, 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 very low yielding fixed rate assets. And it's just kind of like an unthinkable amount of money. And so, given that DeFi yields are lower than they have been, but they're still very, very high in the context of traditional finance, and that is absolutely appealing to sort of traditional financial participants. And I think that something like the recent announcements from Circle, Coinbase, Compound, all of these companies essentially targeting a more mainstream or institutional capital base speak to the demand that they are seeing, right? And so I think that more mainstream and institutional capital base is absolutely interested and wants to participate. Now, what I think will actually take for them to participate, so the incentive is there, right? The incentive is the yield. Now, what it'll actually take for them to participate is time. I think primarily time, right? To see these protocols perform in a variety of different market conditions, and time to sort of get comfortable with their security. That's number one. And I would say like some element of regulatory clarity, right? Now I think that because I think that once you have time tested protocols, and I think so time tested protocols, some insurance option, right? And there's a ton of innovation happening right now in the insurance space in DeFi. So I would say a track record, protocols with a track record, some insurance option, and then some amount of regulatory clarity, so that they don't feel like they're jeopardizing their established business models by participating in DeFi. I think once you have those three things, you're just going to see an absolute flood of capital into the space.
Definitely. And I guess as we even look beyond that point, which maybe a few years down the line, I'm not sure. But as more capital comes into crypto, I'm assuming that some of the yields that we see in DeFi today will also start to converge with the yields we see in the real world. So given that's the assumption, if the yields in DeFi become less of a powerful incentive for these institutions to use DeFi products, does Notional still offer something that's better than the way traditional zero coupon bonds or fixed income instruments are structured, or does it become less attractive to them at that point?
That's a good question. Okay. So I think that all right. So I think that actually in the very long run, I think that I could see DeFi yields being actually lower than traditional financial yields, because like I think that just based on fundamental. So I guess what I would say is that right now, because DeFi is so new, it feels risky, right? And it is risky because it is new. And so that's why we have higher yields. But if you believe in the ultimate promise of DeFi, which I personally do, I think that ultimately it is a lower risk way of organizing a financial system, because everything is transparent, everything is open. You know exactly what this protocol is doing with your money, and if time and analysis has proven that that is a safe thing, then there is no risk of there is no uncertainty, right? Because like the protocol is precisely defined in code, you know exactly what it's doing. So I think that over time, DeFi will be more secure, and less risky than traditional finance. And I think it's quite possible that rates could be lower because of that. Again, over the long run. Now, and then as to your other question of if there's sort of lower rates, is there still an incentive for people to use DeFi? And I would say the incentive is just like it's the fundamental qualities that DeFi offers, right? Which is sort of like this transparency and ease of use and lack of financial intermediaries, right? It's just a more efficient way to organize a financial system. And once the sort of like novelty of DeFi as a whole just becomes more familiar, better understood, and people become more comfortable, I think that the fundamental benefits of DeFi will become clear. And like at the end of the day, those are going to be the reasons why you use DeFi, right? And it's because it's completely efficient. You don't have to use financial intermediaries. There's no one standing between you and your money that's taking a cut. And that's ultimately why I believe in DeFi in the long run. And we have the higher yields now. That's the incentive right now. But ultimately, it's going to be like the base level qualities of DeFi that keep people here.
Yeah, it's almost as if the high yields are the gateway drug today for people to
Yeah,
learn about
exactly.
DeFi and come into it. But yeah, this is such a great note to end this interview on, talking about the implications of DeFi and where you're seeing it go in the next 5 to 10 years. I'm sure a lot of people have questions about Notional. They want to test out the platform. They want to learn about V2. So, what are the best resources for people to use today?
Yeah, so you can go to our website, notional.finance. You can follow us on Twitter at Notional Finance. We've published a lot of content that's sort of related to our upcoming V2. Definitely follow us on Twitter and hear all about what's coming up in a couple months. It's going to be really cool, and you can use Notional V1 and try that out, kind of for a little test run. And in about 2 to 3 weeks, we'll have the Notional V2 UI up on testnet, and you can try that out too. But yeah, follow us on Twitter and stay up to date with what's going on.
Definitely, and I will include those in the show notes below. Well, thank you so much for coming on the show, Teddy. This has been really fun.
All right, thanks a lot, Jason. I appreciate you having me.